Wonderful. Oh, we have some more people here that are bright and early today. I love seeing so many of my own people right away in the morning too. They've been with me all week and here they are showing up on their Saturday as well. Well, as Jeanette said, we are going to be looking at Fibonacci today. So how many of you have used Fibonacci tools in your trading? We got a lot of you. Awesome. All right. Well, today we're going to talk about a lot of different strategies that we can use with Fibonacci. And I know, a lot of people come into Fibonacci and they're like, oh, I don't know, is this bunk? Is this just totally based upon, personal psychology, the psychology of people? Is it something that really works? And so many people say it's voodoo, right? That's what we are going to be looking at today, voodoo in the markets. So the thing with Fibonacci, as those of you that know, is that it is one of those extra tools that you can use to help increase your odds of success in the markets. Why does it work? We don't really know. I mean, everybody has their own theories as to why certain levels hold, why they don't. We're going to be looking at some of the very basics of Fibonacci as we get started here, and then we're going to dig a little deeper. So with any strategy in the market, it's never just about one thing. I teach my people, I've been trading here it's been over 20 years now, full-time, over 20 years, and I trade a lot of different markets. So you guys are asking, what markets are we going to focus upon? Do we focus on futures? Or are we going to be focusing upon options? The great thing about Fibonacci and the strategies that I'm going to teach you guys today is that it doesn't matter what market you're trading. You can be a futures trader, a forex trader, stock trader, options trader. It does not matter. The tools that I'm going to share with you guys today are going to be ones that you can use in any market, in any time frame. I guess I shouldn't just say you guys, right? We got ladies in here too. Yes. All right, guys and gals. Okay, so I can teach anyone. This is a phrase that my art teacher told me over and over again when I was younger. I grew up in the arts. So I actually do realist portrait drawings and paintings. And I took to studying the markets basically the same way. Back when I first got started, one of the big things that people were talking about was the way of the turtle traders. How many of you guys are familiar with the turtle traders? Yes, right. So basically, they took 10, 12 people just off the streets. They ran them through a psychological profile. Out of all the applicants, they picked all of these traders and taught them their methodology. And every single one of them was successful. A lot of people come into the markets and they think, oh, you either have to have some innate ability, or they come into especially in the arts, everybody's like, oh, you have a really great talent, Toni, for your art and everything. I'm like, it is not something I was born with, people. It is something that you work hard for. And there are many drawing courses out there where you can go from a very basic beginner drawing like this guy here on the left, and after just a 5-day drawing seminar, look at his result over there on the right? That's 5 days. Now, look at this one here. This is 21 weeks, okay? That is a really dang nice drawing over there on the right, isn't it, right? Yeah, so that's what we're looking at in the markets. We are going to be looking at the tools and techniques that we can take you from that portrait over there on the left. That's my you can see my handiwork, my actual skill here, right? Because, that one on the left is the one that I did. You can tell I'm not using Microsoft Paint to do my actual drawings. But anyways, Fibonacci, it gained a lot of popularity from people like Leonardo da Vinci. You guys are familiar with him, right? Yeah. So what we're going to be doing is we're going to be taking you from the very beginner artistry here to a much higher professional standard, where we're going to be looking at some of the very basic tools for identifying strategies in the market, and then how to add that confirmation and kick it up a notch. One of the tools that I use, especially when I'm working with newer traders, is Fibonacci. And I'm not really getting into too much why does it work? How does it work? The fact is, it just works, and it's been working since I started trading. I don't see any reason it's going to stop working. Human nature is, we're basically self-fulfilling. I mean, we repeat over and over and over again good behaviors, bad behaviors, and that is what plays out in the markets. Those are what we see in charts. Fibonacci is basically a sequence where you're taking each number in the series, and it's the sum of the previous two. So like 1 plus 2 is 3, 2 plus 3 is 5, 3 plus 5 is 8, and so on and so forth. When it comes to Fibonacci and the tools that we use in the market, we are relying upon the relationships of those numbers in the series, basically dividing them by each other, different levels in that sequence. So the divine proportion, this is the one that you guys are probably the most familiar with. And it's basically if you divide something into two larger parts so that the larger part is divided by the smaller part, it's also equal to the whole number divided by the larger part. And you've got the golden ratio then. It's also called that divine proportion. Here's a number that probably is going to stick out to you when you are looking at Fibonacci in the markets. 38.2, 61.8. These are key Fibonacci levels that we use in our tools. So there's a number of types of Fibonacci tools out there. You've got retracement, you've got expansion, you've got extension, you've got time development based on Fibonacci, you've got Fibonacci fans, Fibonacci arcs. All of these are based upon a certain set of numbers. The first strategy that I'm going to teach you is just very, very basic. And this is one where when you go and apply it in the markets, a lot of resources are citing these levels as holding about 70% of the time, just in and of themselves, regardless of what other types of market analysis you're also adding. And one of the very first and most popular Fibonacci levels in the markets is that 38.2% level. Now, this is found in the sequence by dividing any number in that sequence by the number that is found two places to the right. So, for example, if you got 34 and 89, then you basically get 30.38. And there's a lot of decimals that go way after that, but what we're doing is we're rounding here. And when we get into using these levels, you can use these Fibonacci levels as retracement levels. Like I said earlier, a lot of studies out there, they cite 70% as for how well these retracement levels will hold. And what that means is that you get some sort of reaction off of that level. It's not always going to be a total reversal. It might be something where it just pauses, like you can see right here. This light blue level up here in the highs, this is the 23.6% level. Comes into that level, pauses just a little bit, and is still able to break it. So Fibonacci alone is not going to guarantee you success in the markets. Combining it with other tools that I'm going to be getting here to in just a little bit is going to help you increase those odds of success. So when we're looking at retracement levels, what we are looking for is we're looking for a primary impulse move or trend in the markets. You're going from the lows to the highs of that trend using absolute pivot lows and absolute pivot highs. And then your Fibonacci levels, basically any type of charting platform you guys use are going to have these Fibonacci levels on your charts. They're going to be in your tools. And to draw this one, you're going to be looking at an uptrend. So you're going from the lows to the highs. And the levels you're going to be watching for are these retracement levels. Now, the 38.2% retracement is really key when you're looking at the markets, because when you have a retracement that holds that 38.2% level, you have the best chance of getting a continuation of this previous impulse move, meaning that eventually you're going to get a breakout from that trading range. So if you have a market that is bouncing back and forth between the highs and that 38.2% level, it's going to be easier for that market to break through those absolute highs. The most common time that it's going to happen is the third test of the highs. So here is a trade here that we had a couple of days ago, earlier this week. This was Tuesday, actually. And this was in the NQ. 15-minute time frame here on the NQ. And what I was looking for, actually this might be the tick chart, but right around the 2000 tick chart, pretty close to what the 15-minute chart looks like. And what I was looking for in the market was a really slow, gradual pullback off of the highs. Momentum was nice and strong, coming off of pre-market lows, and we started to see action going into a trading range throughout the entire day on the 22nd. By the time the 23rd came around, we were seeing this range continuing to hold with that 38.2% support level as the retracement point. So when it geared up, began to coil here, nice slower channel, a lot of overlap, pulling back into that 38.2 level, that offered me and the rest of my traders the trigger for a breakout to new highs. We aren't using the break of those previous highs. We're using a break of that channel. That keeps it nice and tight for our return compared to what we're risking. And I'm going to show you guys a little bit later here what we look at for establishing target levels on this as well as this progresses. Now, moving forward, here's another example. This is one back in 2013. The reason I pulled this chart for you is because I've taught classes on Fibonacci for years, and I want to show you guys just how well it works throughout time. It's not something that is just working now just because there's a lot more education out there about how to use Fibonacci, and because it's become a lot more popular than it was 15, 20 years ago. It worked just as well then as it does now. And this is basically just that NASDAQ chart flipped over, except here we're looking at a forex trade that I had. And again, count waves. We're not just looking at Fibonacci. Yes, this bounces right into that 38.2% level right away. But when it hits it the second time, check out that momentum shift. I'm going to be drilling momentum into you guys here and gals throughout the day, because momentum plays a really powerful role in determining whether a Fibonacci level is going to hold or if it's going to just give it kind of a little pause and then you get a break through that level. So the more gradual the move is going into these Fibonacci retracement levels, especially if it's the second wave of retracement off of a low or off of a high, the more likely it is that you're going to get an absolute pivot at that level, and it's going to lead to a really strong continuation move. Now, many times you can get a little bit of a pause when it comes back to that third test of lows, but the odds become higher that it's going to eventually break that support. So you can get into a setup much earlier than a pure channel break just by using those retracement levels. And again, that 38.2% is key. When it goes past that 38.2%, for example, let's say you got to pull up to the 38.2, but it's only that first move off of lows, and then you start to see it go back and forth between 38.2, 23.6. Well, the momentum is actually starting to slow at that 38.2, and you're more likely to see another rally take place coming up into one of the next Fibonacci retracement levels. Often in a situation like this, that's going to be that 61.8% level. And when it goes past that 38.2, especially past that 50%, then previous lows become even stronger. It becomes harder to break them the next time that they get tested. So if you get like retracements back up into this zone in here, and then it turns back around, well, that move all the way back down at the lows has a better chance of holding. So to get a good, solid continuation move on the downside, ideally, you're going to want to see it holding between that 23.6 and the 38.2% zone. And if it goes past that to one of the other Fibonacci retracement levels, you're more likely to see previous lows hold and get reactions off of those previous lows. Now, 38.2% obviously is not the only Fibonacci level that we use. Also, you're going to see 23.6, 61.8, 76.4. These are the three other most common Fibonacci levels that traders will use. You're going to see some other ones thrown out there as well, but these are going to be the most popular. And as long as you have these on your charts, you're still going to catch most of the support and resistance levels that are going to be hitting in the market. So not only are these retracement levels powerful for giving you just reactions off of the levels like the 23.6% here, and the 38.2% here. But as I mentioned a minute ago, they're really great for helping you time trades. So a lot of times when I'm looking at different strategies, if they're coming into one of these retracement levels, then I know that the strategy has more power to it. I might be looking at it based upon something else like wave count, trend placement, momentum. All of these are going to impact whether I take a trade or not. But if they have that Fibonacci retracement level that's corresponding right to it, then I know that my odds of success, especially going into a pivot type of trade, are going to be much higher. You don't have to trade them as pure pivots. You don't have to use them like, see, 38.2 and I'm going to go short at that 38.2% level. Generally speaking, that's not the best thing to do. You want to drop down to a smaller time frame and look for a reversal strategy that corresponds to that 38.2% level on a smaller time frame. This is a 2-minute chart, so you can't go substantially smaller, but you can use tick charts. You can use a 30-second chart. Look for shifting momentum into those resistance levels. Some of the smaller popular reversal strategies that you guys might be familiar with, and I see a lot of you guys in here already that are my long-term traders, so you know some of those popular strategies. Here's a really good example from last week. This was a move that began in pre-market. We had a really wonderful, solid breakdown out of this gorgeous period of correction here from the day before, going into after hours trading. First initial major breakdown. I was sleeping here, did not catch this first move, but what I did notice first thing in the morning was that same retracement. So it offered the first move into the 23.6 level, second move into the 38.2% zone. That helped trigger a continuation breakdown on this particular time frame. It looks exactly like what we see in the previous chart, even though the previous chart is a totally different market, totally different time frame. You're actually looking at the dollar. Here, let me show you guys that. So we're looking at the US Canadian dollar here. And now we're looking at the NQ. NASDAQ futures market here. Totally different markets, totally different time frames, and yet exact same strategy, exact same pattern. Now, I've been doing this for so long that I don't even draw my Fibonacci levels on charts half of the time, because once you get the feel for where those retracement levels are going to be, it's pretty easy to visualize it without physically drawing it on there, but physically drawing it on there just adds that extra bit of visualization. What I usually recommend is that you use some fairly light colors to draw them. So pastels are great. Right, exactly. You can't unsee it. Once you have started reading Fibonacci, you can't unsee the Fibonacci levels. They're going to be there whether you got them on your charts or not. So if you use them really light though, what that can do is it takes some of the sharpness off of it. So you don't get hung up on trading just pure indicators, but you're also looking at the price action going into those levels as well. So I rely really heavily upon using pure price action. I don't use a lot of indicators in my charts. In fact, if you're sitting next to me, a lot of times you're not going to see any indicators on my charts at all. You're not going to see moving averages. You're not going to see volume. You're not going to see RSI, CCI, Bollinger Bands, MACD, any of those, because they're all based upon how price action moves and develops. And all of them work, but you have to learn when they work and when to ignore them. And understanding pure price action goes a long way to doing that. And Fibonacci is one of those tools that gets really, really close to just pure price action. So if I was to tell a trader out of all of the indicators out there which one to start with, you're going to want to use that Fibonacci level. Krishna asked, it can go above that 38.2 as well. Absolutely. So again, the key is if it goes above that 38.2, this previous zone of support becomes a better support level. So here, for example, you get the pull back to that previous low. It stalls it, but it's able to break through it much more quickly. Whereas, on the other hand, if it retraces more than that 38.2, you have a better chance that the market can continue to shift momentum and continue to retrace off of that level. It might not stall, or it might not completely stop at like the 76.4 or the 61.8. That might just stall it and continue the reversal off of your initial support. So how it hits those levels is really important. If it hits it with a slower overall trend and momentum than the previous impulse move, you're more likely to see that break, and that Fibonacci level holds very, very well. So the next way that we can use Fibonacci is to establish target levels. So when we are looking at establishing target levels in Fibonacci, you can use retracement levels. An example here is on WUBA. This is one of my trades last week. This was a gapper. I do a lot of gap trading in individual stocks where I'm focusing upon those pre-market gaps. We had a really powerful gap in WUBA, and right away out of the open, really sharp upside move. And look at how fast it retraced right back into that 76.4% zone. So right away, we are past that 38.2%. It bounces back to the 23.6, drops back to the 50%, bounces again to the 23.6. I didn't have these Fibonacci levels up on my chart when I was trading WUBA, but I know where those zones are. And after you get into a habit of putting those retracement levels on your charts, they are going to stick in your mind. You're going to start to see them whether you draw them or not. You can begin by drawing them darker like this so that you can see them more powerfully, and then just lighten up the colors over time until you get to the point that you don't always have to keep them purely on there. But they're great as that extra confirmation tool to have them on there to some degree, just to give you that extra oomph in your trading. So in WUBA, what I was looking for was not only just the Fibonacci zones, but also a shift in momentum and trend development. In the market, we often get two waves of correction. We saw that on the NQ trade. We saw that on the dollar loonie. We see it over and over again, that once you get a two-wave correction, you're more likely to get a continuation move. Well, in this case, the two-wave correction, the move initially down off of the high, and then the secondary move here takes it into that 76.4% zone. So it triggers a buy coming off of that 76.4, actually had a smaller reversal type of strategy intraday on just a smaller time frame, triggered the buy, but you'll notice how it struggled when it got back up to these upper fib levels. And that was because it had retraced more than that 38.2% level. So my initial target level on this for the first bounce, I was looking for right around that 38.2% zone. Basically about halfway of that original drop there. That's usually where you're going to get congestion starting to happen. Sometimes it goes for a pure base like this, and sometimes it's a little bit messier, but understanding where that level is going to be is going to prepare you for a correction at that point, whether it's one that still manages to creep higher or it's one where you actually end up with a pure price turnaround or correction at that point. You're prepared because of having those Fibonacci levels on your security already. The overall target I was going for was back into the zone of this previous high, basically doing 100% extension here for a continuation move. As you can see though, momentum shifted into that 23.6, and we started to see things kind of widening up. But as it widened up, it continued to hold those Fibonacci levels. Now, Fibonacci levels are a support level and resistance level. What that means is that the harder they hit, the more give they have to them. So for example here, 61.8, look at that tail that takes place at that 61.8. It's because it hits that level really sharply, really strongly. So it pushes through it and bounces back. When you have a more gradual move into a support or resistance level, you're more likely to see those support and resistance hold perfectly. So you're going to find instances where the momentum into a support level is very gradual, and it comes and it bounces off of that level to a T, literally to the exact tick. If it hits it more sharply, it might go like that, and then you'll see it start to hug it, and it will even out along that support level. And that confirms that, yes, indeed, it's a 76.4% level that's serving as support, even if it's pushing through it a little bit to start with. That's just the nature of support and resistance levels. Those of you that use moving averages and other additional types of confirmation tools as indicators will see that happening as well. So here is a little bit of a closer look on that strategy here on WUBA. But there's also another tool that you can use for timing targets. So when you're dealing with a strategy like our NQ, where it has a retracement to that 38.2% level, nice two-wave retracement, two-wave correction, you can use what is called a Fibonacci extension. And you're going from the high of an impulse move to the low of an impulse move to the high of the correction. So the retracement levels are 2-point. Fibonacci levels. These extension levels are 3-point levels. I can show you that, to draw that actually on a chart here, just to give you an idea of what that actually looks like when you're drawing it on a chart. Let me clear this here. You can see I've got my retracement levels up. I'll just remove these. And a lot of them are going to be, you're going to be looking in here, looking at your Fibonacci extension. Often it looks like a little E. And you're going to go from your low of an impulse move to the high of an impulse move, basically where the momentum starts to shift, and then the low. And that's going to place those Fibonacci extension levels on your charts. Sometimes what you're going to want to see is it holding like an initial extension level? And if you have pivot points where you get two pivot points that are really close together, you might need to look and see which one of those levels, which one of those levels is projecting the closest hold on some of the closer Fibonacci extensions. So there's a little bit of wiggle room. And that's where things can get a little bit confusing for people when they're drawing it. That's why I'm showing you these two different levels. Many times you will see it hold specifically right where the momentum begins to shift at a high. And other times it might work a little bit better if you're going to the absolute high, as long as these highs are close together, really close together. And that's the key. So in this case, going to the start of where the momentum shifts, it does come into that initial 23.6 right here, kind of holds that zone. What you can see is that it pushes through it a little bit, but then it pulls back, and that retracement level, or the extension level rather, is right smack through the middle of that line. Same thing here, right smack through the middle of that 38.2 is where your congestion is holding. This whole correction here, right back and forth. So either one of these for how you draw them is going to work pretty well. And again, you guys, when we are looking at Fibonacci levels, the thing that we are paying attention to is not the exact specific price, but also momentum as it comes into these price zones. We're looking at them as price zones of support and resistance. Here is the NQ. This is a 2000 tick chart this week. And I've been trading back and forth on this 2000 tick chart all week. Not only just looking at the continuation moves where you're bouncing off of a support level. Here's your extension. Low of an impulse move, high of an impulse move. In this case, this is a really clear cut, higher high, totally easy to draw that. And then you got the correction all the way back. So your 3-point extension level puts on where these additional Fibonacci levels are going to be. So on the intraday time frames, this is a 2000 tick chart. We use the 200 tick chart, the 100 tick chart, 500 tick chart to play a lot of these back and forth moves within here, looking at these zones for levels of where you can actually get scalps in the opposite direction based upon the moves coming off of those levels, paying attention to two-wave corrections to turn things around again for continuations. And once it gets to that 100% extension, this is often the most common, strongest extension level, as long as your momentum here is the same. So if you are looking at comparable momentum on a trend continuation, that 100% level is basically like a magnet for the markets. Many times you will see it hold exactly at that 100% level. So it is very, very, very tight at those points. Now, when we're looking at, let's go on to our next trade here. When we're looking at target timing with fibs, there's often different impulse moves you want to watch. So you will have a larger impulse move And that larger impulse move can often be made of smaller impulse moves as well. So when you're trying to time initial target levels, you usually want to start with the smaller impulse move. So you're looking at that 100% level right here on that smaller impulse move. And then you can look at larger impulse moves to get a little bit more. What tends to happen though is as it hits the smaller impulse move measured level, that's often where momentum can start to shift. So if you see an impulse move over here that has like this little kind of extra blurb to it, you're often going to get that little extra blurb to it at the highs. I like to tell my guys that blurb is a really technical trademarked term. It's that little extra squish, that extra push in a trend. That's that little blurb that I'm referring to. And when you get that pure momentum move, that is your impulse move in a security. So if you've got a strong measured impulse move, but then you see, oh, hey, there was a little bit of a blurb before that move got started, then you can look to hold a little bit of your position to still get that extra little blurb. And that can take it to the 123.6% extension, sometimes the 138.2% extension as well, depending upon if it goes, does one blurb or two blurbs, and that has a lot to do with momentum. So that can often get you a little bit extra out of the trade. Notice that even though this pushes right through that 100%, just a little bit right here, I know it's kind of hard to see. It's really small there on this chart, right? But look as it pulls back, and that 100% goes right through the middle of that pullback. So that's telling you, even though there were a little bit of trades right up above that 100% level, that 100% was still the main zone that held. Pros running even more stops equals the blurb. That is actually quite accurate. That blurb happens when you got especially a strong impulse move into a support or resistance level. So when the momentum is really strong, stronger than average into one of the support or resistance levels, then you are more likely to get those blurbs happening as well. And those levels are often levels that people get a little aggressive in starting to trade. This is why I say I don't use Fibonacci levels to trade a pivot purely based upon the Fibonacci level, because you can get these tiny pushes. You can get these little blurbs. So you're using those Fibonacci levels, but you're also combining them with momentum. So when the blurb gives you a shift in momentum, that channel break shift is what actually triggers your reversal, and it triggers your corrections. Now, our third technique using Fibonacci, of course, has to deal with this momentum that we've been drilling into your head all day today. We are going to be looking at how to adjust target points using momentum and Fibonacci. We saw it just a second ago with that little blurb going into the 123.6. Well, it works very, very well to even get more off of your position to begin with. So your typical continuation move with your nice little two-wave correction is going to give you a target level right at that 100% extension. Well, when that momentum is stronger than your initial impulse move, you're going to be taking your three-wave extension, and you want to add levels onto it that go past that 100% extension. That's going to mean the 123.6, 138.2, 150, 160, 1.8, 176.4. You're going to keep continuing to add those Fibonacci levels. And what you're going to find is that many times the momentum of a strong continuation impulse move will slow when it hits that 100% extension. It will strike that level, seem to go right through it, especially when you're looking at a larger time frame. This is a 5-minute chart. If you saw this on a 15-minute chart, you might not even see the fact that it slowed here, that it kind of gave a little bit of a pause there and then kept going. But if you have a stronger impulse move than your previous impulse move, you're going to want to look to get more gains on that position than just that pure 100% level 90% of the time. Many times what I'll do is I'll take off just a bit of my position as it's coming into the support levels, but I'm looking to get more off of it. And when I'm looking for target levels based upon these Fibonacci levels, I place my targets on the books before those levels hit. So when I'm looking for 100% extension, my exit to take off part of my gains on my charts is going to be placed on the books just shy of that 100% level so that I am getting out as the momentum is strong into those levels. But when I see the momentum picking up, then I'm going to go and adjust my target levels to get more off at those next continuation moves. What you'll often find is if you drop down to a smaller time frame here, this will have a two-wave continuation, and you can even look for measured moves on those two waves. So this is a 5-minute chart. You go down to like a 50 or 100 tick chart, you're going to see another two-wave move. So here's your main momentum move. You'll get that correction. Then you'll get a continuation and then a secondary continuation where you can actually look at the extension based upon that secondary continuation. That corresponds to the 123.6% level. That's where you're going to be looking to get a next reaction off of. If it goes to the 138.2 like it does here, that's where you're going to expect that next reaction off of. So it's great for helping you get even more out of a position. We see that over and over again in continuation trades. Here's another one. This is the MQ from last week. That continuation right into the morning. It paused a little bit right at the previous low, just because we got this nice inverse V here. When you get this inverse V, previous lows tend to give you a bit of a pause. Goes right into that 100% level. Pretty smooth move, but overall, the larger time frame on this was a bigger breakdown out of a longer range. So the trend placement for this continuation actually had a lot more room for it to go. So we're not just looking at intraday on just like 1,000 tick. We're looking at the placement on the larger time frames. So when you got an average to stronger than average move into these support levels, you can still continue to get pushes to additional Fibonacci extension levels. Here's that first drop for a continuation past that 100%. So then what you're looking for is that impulse move that's going to give you that measured move. Little two-wave correction in here. Measured impulse moves brings you right into that zone coming into the 138.2. Look at how it held it almost to the exact point there. So really, really perfect. How do I draw the 3-point Fibonacci? You are going to be looking at, let's see on this YM here again, show you guys this here again. So when you're looking at the Fibonacci 3-point tool compared to the retracement tool, your retracement tool is right here. So you're looking from the low to the high, and here's your retracement levels. So with a two-wave correction, you've got your first correction into that 23.6. Second correction comes into that 38.2, and that shifts the momentum off of that level. So since it's holding that 38.2, it has a better chance to try to break through some of the previous highs. Comes back up to the 23.6, back to the 38.2. Back up to the 100%, and that's your retracement level. Now, when you're adding your extension levels, you're instead going to be going and using a 3-point move. So you're going to be going from your lows to your highs to your lows. And again, you can often use, if these levels are pretty close, you can look at first where the momentum starts to shift. If that's holding some of the very first extension levels, then you know it's a good place to keep it. If it's not holding them, you can go and adjust it. And oftentimes you're going to find that both of those are still going to fall into pretty close to the same zone. It's another reason you're not using exact Fibonacci point, but you're also looking at momentum levels. So here your momentum is hitting this 50% extension very, very fast. So once it starts to shift momentum into the next level, that's the level that holds even better because it has that shift in the momentum going into that. This is actually a little strategy in here. I call it 2T, where you get that momentum shift into the previous highs. And that's what we're looking at when we're looking at these Fibonacci extensions and retracements for timing trades, is we're looking for those momentum shifts. We saw this again this week on the Dow on the 1,000 tick on Tuesday. We were looking at a strategy I call an avalanche, and it came into that 100% level very, very fast. But on the smaller time frame, you got an initial one-wave drop, a little bit of a pause. So you can also look at the extension where you're looking at this move compared to this move. So that 100% level also puts you at the 123.6% level for the extension. So you've got two extension levels coming together right here to give you that target that goes past the 100% because your momentum has picked up compared to the initial drop. If this had slowed, gone into that 50%, bounced, and then pulled into the 61.8% or the 76.4%, you'd be looking to get out of the position at that 76.4% level because you'd have that measured extension there, the Fibonacci support level, and that shift in momentum. So you would be able to get out without giving back many of your gains just by using those Fibonacci levels. All right, guys, so what is the next step that you need to take in your trading? We are right still up here at the very beginning levels of looking at Fibonacci when we're comparing it to artistry in the markets. We aren't just looking at pure Fibonacci. We are looking at how we apply Fibonacci to things like momentum, to things like trend development and trend placement. That's what's going to get you to that next step, going in here. So what I want to share with you guys now is an upcoming workshop that I have kicking off next month. And in that workshop, I'm going to be looking at the top 3 strategies that I use for Fibonacci. And it's basically giving you the benefit of the one-on-one trading, but at a fraction of the cost. So this 4-week workshop, which includes videos that you can go back and study at any time, kicks off with all sessions right after the market closes at 4:30 Eastern. The first initial kickoff session is going to be on September 12th. That doesn't count to the 4 weeks. That is going to be a session where we just look at the history of Fibonacci and what types of different Fibonacci tools we will be using in the workshop itself. So that kicks off on September 12th. The 4 main sessions run from September 19th to October 10th. With the top 3 strategies workshop, you're also going to get a free copy of Trade Tracker Pro, which is available on NinjaTrader A. You've seen me use that here in my charting. It includes additional tools that you are not going to find in your typical NinjaTrader, like the Fibonacci fans, using additional tools for timing our strategies, built-in alerts, and all of that jazz as well. So let's head back on over here and show you guys a little bit more about this course. So we kick off the course with week 1 by getting into the tools of the trade. And you know what? I'm going to make this 5 tools. So we've got 4 initial tools that we're using, but I'm going to just up that. And we're going to be looking at 5 main Fibonacci tools for strategy development and timing. We're going to be looking at those first initial turnarounds in the market, first continuation strategies in a brand new trend to get you at those very beginning points in a new trend. We'll also be looking at using those 5 Fibonacci tools. Again, I'm changing this to 5, not just 4. We're going to be looking at those 5 tools for riding the trend, continuations in the trend, timing those continuations in the trend. Many of the times I see traders looking at using like moving averages, like 20-period moving average. When I first began to trade, I was told look for a 5 to 7 bar pullback into a 20-period moving average. That's going to give you a great buy. As you guys know, if you've tried to trade like that, it doesn't quite work that well. You might get a little pop, pull back into the trading range, enough to stop you out, then it turns around and it goes exactly like you're hoping it would in the first place. Well, I'm going to show you guys how to use Fibonacci to time that. So we will be looking at not only the Fibonacci retracements, the extensions, we're also going to be looking at fans, time development, and expansion levels as well. So you're going to see a lot of different ways that we can apply Fibonacci, and all of those work together to give you that perfect timing, not just on entries, but also for those target levels and how to time pivot points. So week 4, you guys heard me mention a strategy called a 2T, right? Well, I've got a number of reversal strategies up my sleeve that I'm going to be sharing with you guys in week 4 that gets into perfectly timing the reversals, where you can get in right smack at those beginning moments of the new trend. Not just the continuations of the new trend, but also those first initial moments of that new trend. This is a brand new course. Every single chart, trade example that I will be using in this course is going to be showing you how it is applying to the markets today, and also giving you that confirmation of the fact that these tools have worked over the years. So I'm going to show you not just using current market trades that we are taking right now, that I am taking right now. I say we because I also do live training and live trading, but it's also going to show you how they have worked historically using actual trades from classes that I gave years ago. Because it's really important for you guys to understand that we aren't just talking about voodoo that works in today's current market. It is something that has worked for the past 20 plus years that I've been trading. And it is something that you are going to be able to rely on in your trading in the next 20 years or 40 years. So every single strategy that I'm going to be talking about through each of those weeks, you are going to learn how to pinpoint your entries and verify your intuition by using the Fibonacci as your verification tool. You're going to look at how to establish solid target levels before you ever place the trade, and how to reinforce your target levels, allowing for maximum gain as the trade unfolds, for understanding situations where you can get more out of your trade than your initial target level, and situations where you actually have to adjust how you manage the trade because it's unfolding in a way that you are no longer going to be able to get what you wanted as your first initial target. Is just simply not going to give it that. Some trades, I will get into a position, I will have that 100% extension level as my target level, but I will know because of where the trade is taking place that my potential for hitting that target level might be 90% in some cases, but in certain circumstances, it might only drop down to 60%. I'm still going to take the trade, but I have to know that I might have to manage it a little bit differently. And that's what we're going to be getting into with each of these strategies as well. What levels in the market is a particular strategy going to be more likely to hit that 100% level? Which levels is it going to go way past that 100% level most of the time? And in which levels, in which situations, in which places in the trend is that strategy going to be more likely to risk falling short? And how do we use Fibonacci to then get the most out of that trade and give back the least? So we'll still take the trade to still have that potential, but then you look at getting tighter levels, tighter moves. Oftentimes, like, as people know when they follow me live, even if I quote unquote take a stop on the trade, I'm not fully taking a stop. My wrong trades end up being more scratches where I got small gains or I got small losses, but it's not the full stop. It's not the full loss that I was risking going into the trade, because I'm using things like momentum and Fibonacci to adjust the position as it's unfolding. And that is where we get from pure beginning artist to a pure professional. So as I mentioned, this course, this workshop includes not only those 4 weeks of live training, but it also has Trade Tracker Pro, which is now available on NinjaTrader 8, which is a free download. So you can run that even if you're using another charting platform. It has those Trade Tracker fans, ARCs, and we just added alerts to it as well. So as it comes into those levels, you can actually set it up to give you alerts. You can even use them to trade based off of. So when you're using these levels to establish targets and you've got a moving target because you have a Fibonacci level that is changing like a fan, you can place your exits based upon that fan as it unfolds. So great new tool that is included in that workshop. Like I said, you can use it even if you are not a NinjaTrader user, because you can use it on your daily charts, free download, free after hours data. Also, as part of the workshop, we are including a month of League of Traders. I mentioned to you guys throughout this that all of these examples are from live trades, live sessions. That's because throughout the week, we have a live trading room on Tuesdays and Thursdays where I not only teach, but we also follow trades that are unfolding during the day. And you get to see where we are looking for closer target levels, where different things are impacting the outlook of the market, where you might have to change those target levels. That live trading room is on Tuesdays and Thursdays from 9 to 11. The workshop includes that League of Traders. You go to Toni Hansen/go to sign up for the worksheet or for the workshop. You get live trade alerts and updates sent directly to your phone. We have a members only Monday mentoring session where I talk about specific things each week. Each week is a little bit different. Every session is recorded. Even the live trading room is recorded. A lot of my traders go back and they use the live trading room to actually go back as a lesson, as a class. So if they're not there live, maybe they're doing their own trading, they don't want to be distracted, they go back and they watch it after the fact to learn how I approach the market as it's unfolding live. You're also going to get weekly videos and special member webinars and online strategies and classes and lessons and emails and all of that fun stuff. So this worksheet, the top 3 trading strategies using Fibonacci, is going to give you those 4 weeks of live training plus a kickoff session. All sessions are recorded and available on demand to review anytime. No definite end date. I always will guarantee at least 2 years access on any class that you guys purchase, any course ever. I've been doing this for 20 years. I've been teaching for about 18 or 19 of those because I first began teaching with just starting like the beginner version of a blog at swingtrader.net. We didn't even have blogs back then, but it was at swingtrader.net. And that's how I actually got into doing more of this training, because people started following my blog and asking me, hey, do you want to teach other traders this? I'm like, okay, sure. Why do I do that? I just love teaching. You know, why do people do a lot of the things that they do? I get the same question, like, I've had foster kids for years. Why do you take on foster kids? There's so many issues that foster kids have. You're dealing with all of the difficulties of families. And you know what? It's something that I get joy out of. I like seeing people learn and people progress. When I was a kid, I always pretended to be a teacher, so I get to like play out my childhood teaching by doing this now, along with my own trading, and it keeps me from being bored to death, just trading in my office by myself all day. I love interacting with you guys, and I love seeing you guys have like those aha moments in your own trading. So the workshop includes all of this, all of the memberships, the Trade Tracker Pro, all the sessions, all of the training. We are limiting it to 25 people total because this is going to be a live training session. Absolutely 100% live. So you guys will get logins every single week to join me, just like today. And you'll be able to ask any questions you have throughout the session until each of those points from the session is really drilled in for you guys. So I am limiting it 25 people. We just opened this up today. You guys have first access to it. I know it's going to fill up fast because, see, I've already got some of you that are already there because you're in League of Traders already, and you're like, yes, this is going to give me even more. So yeah, go to ToniHansen.go. First 25 people, no exceptions, $297 for the entire 4-week live mentoring, limited enrollment here, ToniHansen.go. All right, I have just a moment here for any questions you guys might have. I see we've got a ton of them here. Let me see. Let me throw through. Oh, thank you guys. Yeah, I even teach my son here. You guys, we had like a break between when there was no school and going back to school, no camps or anything. So I had my 6-year-old, he's 7 now this week, 6-year-old here in the office. He's like, what are you doing? That looks like a really cool game. I want to play. I'm like, okay, it's a strategy game. He's like, I like strategy games. He loves chess and all of that. It's just like that. Once you learn how to do it, you're just going to keep improving and improving and improving. Thank you. Some of you guys are already in League of Traders telling me how it has changed your trading already. I am just reading through some of your questions. Can I explain momentum on the retracement again? Absolutely. So when you are looking at momentum, let me pull back up one of these charts here. So here's our euro dollar. When we are looking at momentum, what we are looking at is channel moves. When you go onto larger time frames, you're going to see these impulse moves that are playing out over and over again. When you have an impulse move that is average to stronger than average, this is something I will drill into you in the workshop as well, is we are going to be looking at momentum as it applies to Fibonacci. You're going to get these extension levels where momentum can shift. When that momentum shifts and then you're hitting those additional levels, so this is probably like the 123.6 if you're looking at an extension, negative 23.6 if you're just looking at a retracement. It's probably your 38.2%. When it's coming in and shifting momentum into those levels, that makes those levels even stronger. You'll get even stronger reactions and reversals coming off of those levels. So momentum is really key because if it hits one of the retracement levels, this is probably 76.4, hits one of those retracement levels really sharply without much of a shift in momentum, then you have a harder time getting a really strong reversal. This has a little tiny shift, so it pulls back a little bit fast to begin with, but it still is able to go into a range. If it shifted even further into that resistance, you would have an even stronger reversal. What does... Oh yeah, let me put that link up for you guys. It's a really simple link, but let me make sure you guys can see that. It's just ToniHansen.go. Go, 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 go. Go get it before everyone else does. Can I explain what 1,000 tick is? Okay, so when you're looking at charts, there's different types of time frames that people use. When I'm looking at trading futures and forex, I often use a combination of time frame charts and tick charts. Tick charts are basically just showing me every single trade that's happening and where that is happening. So 1,000 tick charts is 1,000 trades at a certain price, at a certain level. And when you're looking at time frame charts, you're looking at like how many, what's the movement in that 15-minute time frame, for example. So your charts are going to look a little bit different. The momentum, the scaling on your charts is going to be a little bit different. If I see something happening on a tick chart versus a time frame chart, they're both valid. Both of them work very well, but momentum can be different on one compared to the other. And that's why I will use both. Tick charts can be really good when you're drilling down to smaller time frames because they can show you the back and forth momentum. And that is where tick charts can come into play. Very easy to analyze in hindsight. Trading this in real life, though, are you simply looking for pin bars into those levels? That is a really good question. And the key thing by using these actual trades here this week is in our League of Traders Live, we're usually getting a couple of trades off. So as you saw, I pulled those trades. In fact, you can go back. You sign up for this workshop here. You can go back and you're going to be able to even view these as they are unfolding real time and how I use the Fibonacci tools on the charts real time. This is not hindsight that I'm showing you guys here. This is something that we are doing day in and day out in the markets, absolutely purely in real time. So am I looking purely at pin bars into those levels? Well, we are looking at into those levels, but we're also looking at the momentum into those levels. So when we have a target level at like 100% extension, then we are looking at placing our order to exit that position as it is going into that 100% extension level. But if momentum is picked up, then we also know that we can get a two-way correction and get it to push past that level into the next extension level. So that's how we're using those Fibonacci levels for our target timing, because when those levels come and correspond to those Fibonacci levels, they react a lot more strongly than just any random number. Thank you guys. I know I'm kind of running out of time here, but I want to thank all of you for making it here today. And I know I didn't make it into all of your questions, but you can email me. You can join that workshop here. You'll get access to the League of Traders, and then you've got me live during the day 4 times a week because we've got Monday mentoring on Monday. We've got live training on Tuesdays and Thursdays, and I have a live session on Fridays too that is called Forward Focus, where we look at the market ahead. And I'll show you guys Fibonacci for outlook on the market ahead. All right. Well, thank you, Jeanette, for having me here today. And I enjoyed it very much. And I hope that you guys did as well. And get out there and enjoy the rest of the weekend this weekend. It looks like we've got some pretty nice weather across the country. So I hope y'all are able to get out and enjoy that. And I will hopefully see you in the workshop here in just a couple of weeks.